you run the European Income Fund for
Yeah.
RLAM. Where are you finding value right now?
It's extremely difficult. It always is. I mean, the market has done awfully well. And the earnings have sort of been trending down, and yet the market keeps going up. And I think it's because there's a paucity of other investments, you know, in terms of bond yields being so low and cash obviously not yielding anything. So we have been hunting for income in not only the utility space, where there's some good companies like GDF Suez, but also some of the telcos such as Telenor, which is exposed to a lot of emerging markets. I mean, most telcos are seeing fairly downbeat numbers. But Telenor has exposure to Thailand and Malaysia, where demand for mobile is still growing. We also own DT, which has got that US asset which it can monetize, and the market situation in Germany seems to be stabilising. But also some of the industrial names, I mentioned Siemens, you know, with a high yield, but Atlas Copco. So generally we've been sort of feeling that there is a moderate pickup in economic recovery, and we've been trying to find companies that are exposed to that. We haven't deserted the emerging markets. Earlier in the year there was a lot of panic about emerging market growth, and that impacted things like Unilever and AB InBev.
Sure.
But I still feel that emerging market growth offers, you know, better long-term growth, and therefore we've kept hold of such names like that. We're also overweight the healthcare stocks, the Roche, Novartis.
Do you like Europe over US?
Sorry, go on.
Do you like Europe over US?
Yes, we do. I mean, we think Europe offers better value. It's trading on a lower multiple. The problem is that there's no real earnings growth in Europe, and that's the market's kind of sitting, waiting for this earnings momentum to pick up. The first quarter numbers were downgraded. I think at the beginning of the year we started off with earnings growth of 12% in Europe ex-UK. It's now down to 8% as the analysts have cut their forecasts. And the fear is that the market is sort of here and the earnings are here, and we're hoping that in the second quarter we begin to see an improvement. The FX effect will probably be less, and you know there is a fairly benign recovery in sort of GDP in Europe, as the IMF was saying overnight. You know, you probably need to do more to stimulate the economies. So it's sort of hunting for a bit of industrial exposure, healthcare, oils we like. There's sort of capex discipline that's coming into the oil stocks is allowing improving free cash flow, so we're overweight there.